Hi, I'm Chris Wright, president of Wright Wealth Management Group. And today during our podcast, I thought I would explore some of the issues that I see occasionally when investors have too much money in non-IRA accounts that are invested in brokerage accounts and in mutual funds. I often see that as individuals or couples come in, they continue to wonder why their taxes are more than they maybe should be, why their Social Security checks are taxable at the 85% countable threshold. And as we sit down and explore and dive into their investment statements, we often find that they have a lot of money in mutual funds. And the problem with mutual funds from time to time with non-IRA accounts is that the mutual fund manager can be creating interest, dividends, and long-term capital gains, to be most specific, within the portfolio. If the mutual fund manager at some point throughout the year decides to maybe sell one company at a gain and buy a new company, he could be creating long-term capital gains, or even short-term capital gains without an investor even knowing. But then in January, when that 1099 comes from the brokerage account company, they notice that a lot of those dollars are going to impact them on their tax return. Even though they did not take possession of those capital gains or spend those capital gains, even if they're reinvested in that account, with non-qualified, non-IRA brokerage accounts such as joint accounts, individual accounts, or even a living trust account, those capital gains could be taxable in the year in which they are earned. I'll give you an example. Recently, I had a couple that came into my office and they were wondering why their income tax bill continues to be pretty high, even in retirement. What we found was that with their living trust account at a local brokerage firm, the mutual fund managers that they had invested in, the mutual fund companies, were spinning off about $65,000 a year in short-term and long-term capital gains. That is not a very tax-efficient portfolio, and therefore those long-term capital gains and short-term capital gains were making not only their federal bracket increase, but also creating taxes on their Social Security income, which many people don't even realize is happening to them, because a lot of people for some reason have been under some notion that their Social Security would never be taxed. But we know that changed in 1983 and 1993, that the total income that accrues, including one half of our Social Security income, is counted back into that provisional income equation, determines whether our Social Security income is taxable or not. So we need to make sure that as we are looking at our portfolio, if possible, we want to take the right amounts from the right buckets of money at the right time. And if we have a lot of non-qualified mutual funds that are held in a brokerage account, we want to strive to adjust those holdings in more tax-efficient types of strategies, where the mutual fund manager isn't simply creating short-term or long-term capital gains by selling one stock in the portfolio and buying another, because of the significant impact that can have on somebody's tax bill. Not only is that impact on our tax bill, but if we're paying additional taxes each year, that's also eroding our savings over time and could potentially affect our lifestyle during our retirement years. It's important, therefore, to have an independent financial advisor review your current investment portfolio to make sure that portfolio is as tax efficient as it can be. There might need to be some adjusting with that portfolio, or changing different sectors or different types of investments in order to bring the overall tax hit down that is being incurred in investors' portfolio. So as investors review their portfolio or as I mentioned earlier, take advantage of a free second opinion with an independent financial advisor, there are other strategies that can be implemented into a brokerage account that's non-qualified to help reduce the amount of taxes and capital gains that are produced. There may be investments that are tax-free. There could be investments that are more tax efficient without turnover ratios that are quite high, creating additional capital gains. There's other investments that are tax strategic, that give an investor the ability to earn interest and over time, but have a portion of the interest to be deferred over time, and then some point down the road that interest can be converted to long-term capital gains instead of ordinary income. There's a lot of different strategies that can be implemented to help investors reduce the overall tax bill if the proper planning is done over time. Investors can implement tax strategies throughout their non-IRA accounts, their brokerage accounts, living trust accounts, joint accounts, that are more tax efficient than maybe what they're investing in currently. And as we reduce the tax bill over time, those are real savings dollars that the investor can hold on to, keep, and reinvest to help build their portfolio for the future, to help them sleep better at night, and also to provide maybe some additional disposable cash for those types of events that arise, and even emergencies that may occur in the future. I'm Chris Wright, President of Wright Wealth Management Group. I hope you'll join us next week for an additional financial topic. Securities offered through Center Street Securities Incorporated, a registered broker-dealer and member of FINRA and SIPC. Wright Wealth Management Group is a registered investment advisor licensed in the state of Arizona. Wright Wealth Management Group is independent of Center Street Securities.